Hey, by the way, folks, the stock market had a great year, as we all know. It dominated the headlines and the news of late. And of course, the metals I just mentioned coming on really strong. So you've got all of this excitement, but lost in it, the bond market. The bond market is actually fetching a bid. It's alive, but the question is, should you be a buyer? Let's bring in Bianco Research President Jim Bianco. Jim, listen, U.S. bonds shined in 2025, but returns could lose altitude. Just want to talk about that because bond volatility has subsided really nicely, and a lot of times people think that's a harbinger for, sort of a bond rally. Your thoughts?
Yes, it has subsided, and we have been having a bond rally. Now, the major indexes like the Bloomberg Aggregate, which is like the S&P 500 of the bond market, is up about 7.5% or 7.25% this year. And that's pretty good, especially when you compare it to non-AI stocks, which are up around 9% for the year. So it's been competitive with that group. And the volatility has been coming down because we've been getting a little bit more certainty. I know it's hard to say because everybody's so uncertain, but we have been in the bond market this year. But that can change next year. Headlining that would be who's going to be the next Fed chairman and what's their mandate going to be.
Right.
That could really turn the volatility around if it doesn't come the way the market wants.
And speaking of that, of course, the people are saying, hey, they're going to gun it. They're going to run this economy hot, with the new Fed chair in there. And yet, the U.S. inflation swap rates, they seem to be signaling a serious amount of calm there. So, is it too early to even know where inflation may end up next year?
Yeah, well, two things about that. The swap rates have been coming down because the biggest driver of them has been gasoline prices. And gasoline prices are now under $3 nationally for the first time since early 2021. If gasoline prices stay down, they'll stay down. But the other thing is, pre-COVID, those swap rates were well under 2%. So that market is still telling you that there's a residual inflation in this market. I've been arguing that we're in a 3-ish% inflation world. We're no longer in a sub 2% inflation world. And that matters for interest rates. That will keep interest rates, I think, at these levels or maybe higher.
So you mentioned the ag a minute ago, AGG. It has started to pick up a little bit of momentum here. Would that be a buy? Because I know you're concerned about government bond, the 10-year yield. You keep questioning. I see you're questioning out, why, and everyone's questioning, why hasn't it gone under 3? Why is it staying here? And what does it mean about the secular bull market? Is it completely over?
Yeah, well, I do think the secular bull market in bonds ended in 2020 when we were at 0.5% on the 10-year. Now we're, somewhere at around 4.10
right.
to 4.15 on the 10-year. But that said, bonds are also, they return you a coupon. So even in a bear market in bonds, there's still opportunity to at least earn a coupon. And if you time it right, and some bond managers can actually do that, you could get a little bit more than that. But I do think that what you've seen with the bond market is every other year is a good year. We had a good year in 25. And then it's followed by a tough year. 24 was a struggling year. 23 was a good year. 22 was really a very bad year for the bond market. So I think you could probably see the bond market kind of stall out a little bit in terms of yields going up. But again, there's a coupon to be made there, and there is opportunities in it.
Hey, Phil, I got less than a minute to go, but I got to ask you about the consumer. Obviously, we see consumer sentiment, consumer confidence completely in the gutter, right? But we know next year, it looks like people are going to get a nice, hefty raise. The economy should do much better. You're getting big tax refunds. Where do you think the role of the consumer, the impact from them on the economy and the market next year?
I agree with you. I think that there is the potential that the consumer could pick up, especially with the refunds and with a rebound in the economy. And that let me come full circle back. That gets me back to where I was with interest rates. Remember, we've got this idea that interest rates down is always good and up is bad. And that's not the case with interest rates. Sometimes higher rates are appropriate if your economy is doing a little bit better and you've got a little bit of inflation. It shouldn't be something to be feared. It's only feared if you're an over-levered economy, and I hope we're not. So if the consumer rebounds, and I think they do, and the economy picks up, then interest rates might go up, and that's not a bad thing. That shouldn't scare anybody unless they're too over-leveraged.
I'm glad you said that, man. That was something that was very important, had to be said. Happy New Year, Jim. Talk to you again soon.
Thank you.